Good morning, everyone, and welcome back to the Daily Hunt from Multibaggers. It's Thursday, April 16th, 2026, and we're looking at some fresh market commentary from yesterday, April 15th.
We definitely had a busy day of data to sift through, Ethan. Our AI flagged over 600 user discussions and several unique stocks that got a lot of attention. The overall sentiment out there feels quite dynamic, with a clear focus on tech and some interesting shifts in other sectors.
Absolutely, Brooke. There's a lot of promising chatter about growth potential, especially in the tech space, but also some bold bets in energy and the broader market. It's an exciting time to be looking for those potential multi-baggers.
Let's kick things off with a name that's been making waves, Robinhood, or Hood. Our system flagged an overwhelmingly bullish sentiment of +8, primarily driven by news about the SEC scrapping the $25,000 pattern day trader rule. This is a huge regulatory tailwind, Ethan.
It really is, Brooke. Users are calling this incredibly beneficial for Robinhood, expecting a massive boost in retail trading activity and transaction volumes. That directly translates to higher revenue for them. We're also seeing significant insider buying, which really signals internal confidence in this regulatory change. And, the stock has been on a nice upward trend already. This is an upgrade for Hood from its recent stay away ratings.
I agree that the potential is there and the market reaction has been swift, but it's worth noting that the full implementation of this rule change might take a few months. Still, their current revenue growth at 0.265 and net profit margin at 0.42097 are already very strong, showing they're well positioned to capitalize on increased volume when it comes. The high beta of 2.464 means it's volatile, but in a bull market, that can work in its favor.
With that kind of tailwind, I'm leaning heavily towards optimism here.
Given the strong future potential despite the slight implementation lag, I concur. For Robinhood, Hood, our AI-generated insight today is a buy.
Next up, we have Cheniere Energy, LNG. Our analysis showed a cautiously bullish sentiment of +6. The community seems to think Europe's energy situation and geopolitical factors are setting LNG for some significant demand this winter. There's even talk of long-term deals locking in future growth.
While the geopolitical drivers for LNG demand are certainly compelling, Ethan, we have to look at the numbers. LNG's debt-to-equity ratio is quite high at 202.217, which indicates significant leverage and a risk factor to consider, even for a capital-intensive industry. There's also been a slight net selling by insiders, though it's a small volume.
True, that debt is something to monitor. But then you look at its PE ratio, which is relatively low at 10.64, suggesting it might be undervalued. Plus, revenue growth is solid at 0.123, and that net profit margin is impressive at 0.27352. If demand continues as projected, those numbers could get even better. LNG has consistently been a buy for us recently.
The low PE and strong profitability definitely make it attractive. The upcoming earnings report on May 7th will be a key reality check, as some users put it. But the fundamental case for sustained demand seems strong enough to warrant a positive outlook, provided that debt is managed.
Okay then, for Cheniere Energy, LNG, our AI-generated insight is a buy.
Now let's talk about Webull, ticker BULL. The initial post was very bullish, calling it generational wealth, giving it a sentiment score of +3. However, my KPI-driven analysis immediately raises red flags. The poster certainly had conviction, and we did see news about a strategic alliance for hybrid quantum HPC integration in Europe, which sounds innovative. Plus, there was a small amount of insider buying. That could be a sign of future growth. Could be, Ethan, but the current financials are alarming. It has negative earnings per share at negative 0.137, meaning it's unprofitable. The debt-to-equity ratio is extremely high at 7.627, and its stock performance has been disastrous, collapsing from a 52-week high of $38.61 to a current price of $6.47. A strategic alliance is a future hope, not current profitability. This one has mostly been a stay away for us for a reason.
That's a pretty tough reality check, Brooke. Generational wealth is built on more than hope, you're right.
Exactly. For Webull, Bull, our AI-generated insight is a stay away.
Moving on to Tesla, TSLA. We saw multiple posts about TSLA with strong bullish sentiment, hitting scores of +8 and +7. One user made a highly aggressive options play, reinvesting profits into even riskier bullish calls. Others are highlighting AI chip milestones and FSD wins in Europe. Even Cathie Wood bought nearly 80,000 shares. Analysts are calling Tesla a leader in physical AI.
I hear the excitement, Ethan, and the news does paint a very optimistic picture. However, the KPIs present a contrasting view. The PE ratio is astronomical at 332.16, meaning an incredible amount of future growth is already priced in. Even more concerning is the negative revenue growth of negative 0.031. For a company valued for growth, that's a significant red flag. Its high beta of 1.915 also means it's extremely volatile. This one has consistently flagged as a stay away or speculative gamble for a reason.
But the market is looking forward, you know? FSD in Europe and new AI capabilities could totally turn that revenue growth around. The market is betting on those future breakthroughs to justify the current valuation.
It's a high-stakes bet. While the long-term vision and innovation are undeniable and could theoretically improve future KPIs, the current financial metrics suggest immense risk for value-oriented investors. It really is a tug-of-war between future potential and current fundamentals. Given the strong community optimism and the long-term technological vision, but with your very valid points on current valuation, I think a balanced approach is best here. Agreed. For Tesla, TSLA, our AI-generated insight today is a cautious buy. Let's discuss Microsoft, MSFT. We saw several posts, all exhibiting a strongly bullish sentiment, with scores ranging from +4 to +8. Users are celebrating recent gains and regretting not buying more, with high price targets in mind.
Yeah, the community believes Microsoft's AI investments are truly paying off, driving strong quarterly earnings and leading to big gains. Analysts are maintaining outperform ratings and setting price targets significantly above the current price. There's real excitement around its AI data center push and upcoming earnings. Microsoft has been a strong buy for us many times before.
The KPIs absolutely back that up. Microsoft boasts impressive revenue growth at 0.167 and an exceptional net profit margin of 0.39044. Their earnings per share are solid at 16.0, and a PE of 25.70 is quite reasonable for a tech giant with this kind of growth. While there are questions about AI investments being a capex trap, their current profitability clearly demonstrates strong execution. The stock is also trading below its 52-week high, suggesting room for growth towards those analyst targets.
That's a strong financial picture, which always makes an optimistic outlook feel more grounded. With upcoming earnings on April 29th expected to potentially drive the stock even higher, it certainly feels like a compelling opportunity.
Indeed. For Microsoft, MSFT, our AI-generated insight is a buy.
Finally, we have NVIDIA, NVDA. A user celebrated a quick $2,300 profit on NVDA calls, and the news is just overwhelmingly bullish, pointing to continued market outperformance and huge future potential, like reaching $300 or even a $10 trillion market cap by 2030. They're clearly leading the AI revolution. NVDA has had a lot of buy ratings recently.
NVIDIA's KPIs are truly exceptional, Ethan. Revenue growth is an astounding 0.732, net profit margin is 0.556, and return on equity is over 1.0. These are incredible numbers that justify a lot of the enthusiasm. However, the stock is trading at a high PE of 40.17 and PB of 30.72, which reflects that high growth is already priced in. While I appreciate the strong fundamentals, that valuation means there's less margin for error. We did see Michael Burry adding to his NVIDIA puts, a slight countersignal.
But the insider buying is huge, Brooke. Over 58 million net shares purchased in the last 6 months. That's a massive vote of confidence from those who know the company best. That sort of internal conviction, combined with their undeniable market leadership in AI, really makes the growth story compelling.
The insider buying is a very strong positive signal, I agree. And those KPIs truly are remarkable, showing incredible efficiency and market dominance. While the valuation is stretched, the company continues to deliver.
For NVIDIA, NVDA, our AI-generated insight is a buy. All right, so to quickly recap our top candidates from today's data analysis for deeper investigation. Investigate as buy, Robinhood Markets Inc., Cheniere Energy Inc., Microsoft Corporation, NVIDIA Corporation. Investigate as cautious buy, Tesla Inc. Investigate as speculative gamble, Webull Corporation. And that wraps up another episode of the Daily Hunt for Multibaggers. This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset. Thank you for joining us today. We'll catch you next time on the Daily Hunt.